Welcome to the Konvergent video series for the week of June 8th. The market had quite a ride last week, especially near the end of the week as the unemployment data was released from the Bureau of Labor Statistics, and we'll get into a lot of that later in the video. But I've been really talking the last couple months on these videos about how cautious we are given the data that's out there, the market volatility data, the economic data, and our investment process is a very rules-driven process where we really use the data to dictate how we manage portfolios. And so we've been definitely cautious through all of this market increase. But we've made some adjustments last week. We've added some market positions to try to keep up with the market as it continues to rise, if it continues to rise. Those may be 1 week positions, they may be 1 month positions, or we may add to them if we do believe that this market rally will continue to be sustained, or it can go the other way. So we're going to be nimble, we're going to keep an eye out, but we're still going to use our data in our rules-driven approach to manage money through all of this. So with that, the market last week was up over 4%, and really a lot of that came on Friday at the end of the week as the unemployment data was released that I mentioned earlier. But as we've been covering on these videos, what really has been happening as the market has been going up is we've had this big divergence with earnings in the market. And so now the S&P 500 is at some of the most expensive levels that it has ever been, and really with a forward PE ratio of about 25, we're back to levels that we haven't seen really since 1999 at the very end of the dot-com bubble. So that doesn't mean the market's ready to go down. It doesn't mean it could or should go down. It just means it's expensive, and it's something that we're going to remain cautious around and keep an eye on. So let's look at the economic data for last week. So really it's all about unemployment. So Thursday we had new claims for unemployment that were released, and those numbers were 1.8 million of new claims. And we've seen a really nice downtrend in the level of new unemployment claims on a weekly basis. However, if we think back to pre-coronavirus, if we'd had 1.8 million claims of new claims for unemployment in any week prior to the coronavirus, that would have been huge headlines. And now it's almost like nothing is going on with that. But I think a more important data point that was released last Thursday was the continuing claims for unemployment ticked up a little bit, actually, up to 21.5 million. And I think that's going to be the more important number to keep an eye on is where are continuing claims? Are people staying on unemployment longer? So that's really the number to watch. But really the big news, the fireworks last week were all around Friday and the release of the Bureau of Labor Statistics data on unemployment. And we saw the rate of unemployment drop down to 13.3% as there was a surprise upside of 2.5 million jobs added to the economy when most economists expected actually to be a continued drop in employment in that report. So market had a huge upside as everyone is believing that everything's just going back to normal and the economy's opening. But if you actually look at their data, their own notes indicated that a large number of people were misclassified. And if those people were classified like they were typically before the last couple of months, we would have seen an unemployment rate closer to 16%. And so while it's very good news and still would have come down from what it was the previous month, overall having an unemployment rate of over 13%, having over 20 million people unemployed is still a challenging place to start from. And so we're going to keep an eye on it, and I hope that this continues here, and we'll look for the numbers in June. So what does this all mean? The reality is I don't know, and anyone who tells you that they know is definitely lying because there's still just too much unknown to know for sure where things go from here. But looking back over 20 years or so of my career, I started my career, my first full week as an advisor was the week of 9/11. And even after 9/11, as I brought on new clients, many of them were still expecting the returns going forward to look just like they did between 1995 and 1999 at the height of the dot-com bubble. And it took another year of poor market performance before they finally recognized that profits matter and revenue matters, and it's not different this time. I then became a branch manager in 2007, at the very end of 2007, and I was managing 20 advisors and working with them on all of their clients. And none of them believed that real estate could ever go down again. And it took another year and a half or so of bad market performance during the '08 crisis before people recognized it is different. It's not different this time, and that real estate can go down in value. Will this time be different? Will the market be able to continue to march ever and higher without good fundamentals? Will the money that the Fed is pumping into the system, the liquidity they're providing, truly change this to a new paradigm of how investing happens and that fundamentals don't matter? I don't think so. I do believe at some point fundamentals will matter again. Corporations will have to be profitable. The overall economy will have to grow. And it's yet to be seen whether the current market levels will be justified by corporate profits improving and GDP getting back to pre-coronavirus levels, or whether we'll need to see the market come back down a little bit to more reflect the actual data. So, again, I don't know when that will happen, but I do believe at some point fundamentals will matter again. So what are the things that we're looking at related to that? So I think there's a few things coming up in the next couple of months that are really going to tell the story for the future. The first one is Paycheck Protection Program funding. Those first loans were given out in early April, and the requirement on those loans for them to be forgiven for small businesses was they had to have their employment levels at the same amount as pre-coronavirus. And they had to keep them on the books through the 8-week spending period that the loans provided for. And those 8-week periods are just coming to an end now. And so I think it's going to be very important to see what happens in the next 3-4 weeks as these businesses, these small businesses, some of them that may not be able to get back open again or survive in this new social distancing world, it'll be very important to watch what happens to unemployment related to that. I think the second one to keep a close eye on is the pandemic insurance for unemployment claims and the extra $600 a week that people are receiving on unemployment right now. Those end at the end of July. And while I do believe there'll be some extension of those benefits, will it be at the same level? So will as much liquidity be coming into the system? And with that, today, this morning, we saw a headline released from the White House indicating that they're keeping a very close eye on the economy and especially on the jobs reports, and that it's going to have a major impact on the next coronavirus funding bill, the fourth bill that would be coming out. And so, even if the economy is not going on full steam, but it's just starting to improve, some of the liquidity that's been put into the system may get sucked out of the system. And so what will happen when that happens? And then the last thing that I'm keeping a close eye on is coronavirus cases. So again, with everything going on, with the civil unrest and with the economies reopening, what's been kind of lost in all that shuffle is that coronavirus cases across the globe are actually at the highest levels that they've been. And even in the United States, cases continue to rise slowly, but that is a concern. Now, I don't believe that governments will shut down the economies like we did in March, April, May if we get a big second wave of coronavirus. I think that was clearly seen to be too damaging, and we have more information now about the coronavirus itself, and I think we know that it's maybe not be quite as deadly as we originally thought. So with that, though, those that are most vulnerable to the coronavirus may choose to opt out of this opening up of the economy. If they choose to stay home, not go out to eat, not travel, that could impact how quickly the economy recovers and could have a major impact on what happens to corporate earnings and GDP growth. So those are all really important things that we're keeping an eye on, and still why we're even though we're adding some market positions on the long side, we're still very concerned about where things might go from here because all of these are big unknowns. I still believe we're very early in this. We're still only maybe in the third inning of a 9-inning game here, and there's a lot to come. And so, but we're going to be nimble, and we're going to react to what we need to do to try to perform in this environment. So with that, if you have any questions on your individual portfolio allocations and you want to have a conversation around what we should be doing for you, don't hesitate to reach out. Happy to sit down and go over that with all of you. So with that, we hope you have a great week, and we'll look forward to talking with you all very soon.